Hello and welcome to another episode of Darwin Investors. Well, what can I say? I think USOI is actually really good. I like it. I own it. I've tried it. I'm not selling it. I'm not going to add to the position at all. I don't see that because I already got so much of it. And I do like it because with the current market conditions, they're trading choppy but sideways. I'm getting that really nice dividend. Speaking of, I don't know what the dividend is going to be in March, but I'm just kind of hoping to hit the lottery with it then. I also don't see that the price of oil is going to be coming down much, in the near future at all with China reopening. And then, of course, the war in Ukraine isn't doing the commodity complex any sort of favors. So oil has been trading, say, between $70 and $90 a barrel. And now with China reopening, I do see that the price per barrel may be trending more towards the $90 range in Q2 versus the $70 range right now. That's just the way I feel about it. And that's the reason why I hold on to so many energy stocks right now. But we'll get into all of that later when we're discussing my portfolio. Also, you might have noticed that inflation has been in the news a lot lately because of a hotter than expected January CPI print. And that's been causing the federal funds rate projections to rise, bringing the bond market more in line with what the Fed has been saying all along. Now, I'm going to go ahead and weigh in on inflation on this video, and I'll give you my thoughts about what's going to happen when the CPI print comes out on March 14th and where I think that that's going to actually drive future rate hikes. But right now, let's go ahead and discuss the bonds versus stock debate, which has also been in the news a lot lately. And I'm not here to promote one over the other because they both have their merits, especially if you've already made it and you've got like tons of money, probably just want to go entirely risk-free. But for my position and for my net worth and for my current liquid assets, I definitely prefer one over the other. So let's go ahead and get into this. So due to higher interest rates, a lot of money here recently has been flowing out of equities and into sovereign bonds. And it's a lot of the reason why people might think that the price to earnings ratio of the S&P 500 should actually collapse. And that's because we have options now that we didn't used to have. So as a result of this past week, $9 billion has been pulled out of equities and put into sovereign bonds, and $10 billion was put into investment grade corporate bonds. And now when we're talking about investing in bonds, a lot of them are done through ETFs. So what are some of the more common ETFs that people are pulling their money out of equities and they're putting their money into investment grade bond ETFs? And this article lists a few of the more popular Treasury ETFs of the past week. So short duration Treasury ETFs gain favor as rates reverse course and push higher. The recent moves higher in Treasury yields appears to be sparking a shift back into short-term bond funds by investors. And in the ETF space, investors are voting with their feet. The three biggest funds for inflows over the past week were short-term Treasury ETFs, led by the iShares Short Treasury Bond ETF, ticker symbol SHV, and this is according to FactSet. The three biggest were SHV with $2.4 billion of inflows last week, BIL, which is Spider's Bloomberg one-month Treasury bill ETF with $976 million worth of inflows, and Spider's portfolio short-term Treasury ETF with $954 million of inflows, ticker symbol SPTS. Let's go ahead and look at some of these Treasury bills and see if they're good, how they've been forming, how they've been doing this past year. Let's look first at SHV. So SHV is selling for $110 a share. It looks like that it pays dividends out monthly. Over the past year, it's been basically even. Let's call it zero. Morningstar rates it 2 stars in the short run and 2 stars in the long run. But however, over 3 years, it says that it might be a medium type of investment here. It does pay the dividend out monthly. It's got a 4.34% annual dividend yield, meaning that if it's even, which this one is over the past year, that you will have made 4.3% on it. Its holdings here, it looks like it's got about 32 holdings, all of which seem to be Treasury notes. So this one doesn't seem to be too bad, not too good, but not too bad. I guess if you're up 4% over the last year, that's actually not a terrible thing. That's actually decent. One of the other ones here was this BIL. This is the 1 to 3 month Treasury bill ETF from Bloomberg Spider here. It's selling for $91 a share over the past year. It's actually been up, so that's a bonus. It does also pay a monthly dividend. It looks like its payout is 4% annually. Its holdings include nothing but looks like Treasury bills, just as it says in the title. It's returned 4% over the past year, including the dividends, as has SHV. I'd say these two are pretty interchangeable. Neither one's any better than the other. Let's have a look at this last one here. This is SPTS. This is Spider's short-term duration ETF. It trades for $28 a share. Over the past year, it's down 4.32%. Morningstar seems to favor this one over the others. Let's see if we can figure out why. It pays out a monthly dividend yield, and annually it's 4.27%. It holds nothing but United States Treasury notes, just like it says in the title. It looks like over the past year, it's only returned 0%, whereas the other two have returned 4% respectively. I would say that I probably favor either SHV or BIL over SPTS, at least based on the last year's performance. Again, 4% is great for, I guess, if the whole S&P is down 22% for the year, but I think under normal circumstances these aren't the best options, at least not something that I'd be very interested in. And now here it says that the 6-month Treasury yield this past week actually topped 5%, and here's how you can put your idle cash to work. So you may actually just want to put it here in the 6-month Treasury. Now realizing that 5%, if you put in, say, $1 million, you're not going to get back 5% in 6 months. You're going to get back 2.5%. But let's say that you left it in for a full year. You get your $1 million back, and you'll also get $50,000. So it's really just, I don't know. I'm just not a bond guy. I don't know why you would put your money into one of these things unless you really think that the market is going to tank, which I just don't. So let's see how bonds have responded or how they've behaved relative to the S&P 500 over the past, say, year. So I'm going to go in here. I'm going to compare. This is the S&P 500. Let's go ahead and compare this to the iShares US Aggregate Bond ETF and see how this has actually performed relative to all of the investment grade bonds that the United States has to offer. And you can see that over the past year, these two have been basically equal. But if you look at, say, investment grade bonds versus the S&P historically, you would see that actually that the aggregate bond ETF here has been way outperformed by the S&P 500. So again, this iShares Core US Aggregate Bond, it just isn't my style. I don't think I would like doing that. However, if you did over the past year, they've been about the same. So all this tells me is that I would rather just invest my money into high dividend yielding stocks that I believe have, that you can get some yield out of your stock. You can sell calls on it. You can sell puts on it if you felt like it. And then you could also possibly get a little bit of equity appreciation as well. So for me, I'm just not big on bonds. I know that people love these things right now, but I think that just for my particular, maybe if I had $50 million, I guess instead of getting $50,000 a year, I'd get $500,000. Maybe if I have $50 million, sure, bonds. But at my level of income, I just don't see why I would put my money into something like that, especially when you feel the same way about the market that I do. And how do I feel about this market? Well, I'm definitely not a technicals kind of guy. I don't put a lot of merit into this sort of thing. However, if you look at the way things have been trending with the S&P 500, you can see that since October, we've been hitting a series of higher highs and a series of higher lows. And this is all despite the fact that investor sentiment is coming down. We're tailing in a bearish direction right now. We're only 21.6% of retail investors see the S&P being higher in the next 6 months and 38% being lower. Despite all that, the market has not been crashing down. And I see this as a very positive sign. I mean, we're having huge outflows out of equities, huge inflows into bonds, and yet the market is still standing strong right now. And I believe this is because the market is actually trading at a pretty reasonable multiple of 18 times forward earnings. Now, if you were to just strip out Amazon and replace it with Apple, the market is actually trading at 17 times forward earnings. So really, it's Amazon that's kind of got this whole market multiple out of sorts. Plus, we are going through a disinflationary trend right now. Even Jerome Powell admits as much. And so I am bullish on the fight against inflation. And then when I think back to January, I mean, that month was all juiced up. You go on social media, everybody's complaining about the high price of food. You drive down the street, I've seen the neon signs showing me the gasoline has been going up. But when I think about February, I think of like the commodity prices are coming back, like some are even crashing, such as lithium and lumber. And that's got those stocks going kind of in a tailspin right now. As a matter of fact, let's go ahead and look at the price of lumber right now, because to me, this is kind of a microcosm of kind of the inflation that we experienced in January relative to what we're experiencing right now in things like lumber and things like natural gas. So when we look at it here at the beginning of January, lumber was right here and then it spiked all the way up here on January 31st. And then look at the way it's crashed here in February. And the same could be said for lithium. The same could be said for natural gas. And so last month was just kind of like a juiced up month. And so this month is going to be a lot better. So what can we expect when the CPI print comes out right here on March 14th? Well, if we remember, everybody kind of got up in arms about inflation last month, and that's because it was up 0.5%. But year over year was actually down 0.1 from 6.5 down to 6.4. And that was even when they adjusted December, went from negative 0.1 to positive 0.1, which is, by the way, about where I predicted it would be a couple of videos ago. October went from 0.4 to 0.5, and August went from 0.1 to 0.2. And despite all of these upward revisions, the year-on-year inflation rate was still lower this month than it was the month previous. And so what am I expecting next month? Well, I expect that food will actually come down in February relative to January. I think that energy is actually going to go negative this month relative to last month. I think that this piped gas service will actually come down. It actually spiked straight up. Even though natural gas has been coming down, the explanation for this is that when you get the pipe services to your home, you're actually getting the price of natural gas months ago and not the most recent price. But I don't know. We'll see. I'm expecting this one to come way down. I think the price of apparel will finally come down. I mean, it spiked straight up. I mean, are you kidding me? You can get a deal on anything right now. So what I think is actually going to happen in February is we're going to get a price of zero. It's going to be zero. It's going to be this month over month. But just to give you the calculation very conservatively, we'll go ahead and figure it out at 0.2 and see what our year over year calculation will be for inflation. So all we have to do is we go over to this chart here. We look at this number here. Let's go ahead and calculate the current CPI print. So all you do is you take this number here, and that's 300.536, and you divide that by the number 1 year ago, which is this number here, 282.599. And that going to get you somewhere in the vicinity of 6.4%, in this case 6.35%, which actually rounds up to 6.4. So if we was to do this, and I'm saying that we're going to actually add 0.2 month over month, and I think it's going to be zero, but let's say for the sake of argument it's 0.2, you take this number here, 300.536, and you multiply that number by 1.002, and that'll get you this number here. And if you divide this number by last February's number here, which is 284.610, it's going to get you a year over year inflation reading of 5.8%. Now that's a pretty conservative estimate, but it still gets us below that psychological 6% threshold. And I think that's going to push the market straight up, because people are going to stop suddenly talking about, oh, we're not going to price in a 50-point rate hike at the next FOMC meeting. We're actually going to be pricing in a 25. And when we start pricing in that 25 multiple and that 10-year bond yield comes down and that 2-year bond yield comes down, the price of equities is going to go up. And so this is going to send the market straight up. That's what I'm predicting for the next CPI read. Now let's go ahead and see what happens if this comes out exactly as I think it's going to come out, which is going to be zero, which is this number here, 300.536. And you divide that number by this number here, 284.610. And that would get us a year over year inflation reading of 5.6. So it's not going to be a ton of difference, 0.2 versus 0, and even negative 0.1 isn't going to have much of a difference either. But either way, we're going to get below that psychological threshold of 6, and we're going to start looking straight at 4. And look, when this month goes from here to here, that's like up in a straight line. So we're going to get below 5 in the next CPI print. And for all these reasons, I think that 50 basis point hike is off of the table. Now the FOMC meeting, here's the calendar here, and this is really important. So you can see that here in March, they're going to meet on the 21st and 22nd. The CPI print is here on the 14th. Now we're going to get a very cool inflation read on the 14th here. But you can see this is the blackout period for the Fed, so they can't come out later that day. Bullard can't, maybe Bullard can, I don't know, but I don't think he can. Any of these guys can't come out and say, no, 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 you don't understand. Inflation is terrible. We got to raise rates to the roof. They're not going to be able to do all that stuff until after this FOMC meeting here. So not only are we going to get a cool inflation read, we can't get any Fed people come out here to stop the momentum. So I think the market's actually going to go up pretty good right here on this day. Nevertheless, I'm going to stick to the equities that I hold. And those equities just happen to be a lot of energy stocks and a lot of dividend stocks. So let's have a look at those. So here's a quick overview of some of my portfolio. Now you can see as I have USOI right here. I got 650 shares of that. I have two covered calls open, one on Marathon Petroleum, one on Phillips 66, and I've sold two puts, one on ConocoPhillips, one on ExxonMobil. I like these stocks right now that have a lot of, that I think potentially have a lot of upside. I really like the energy stocks right now. They also pay a nice dividend, so I'm maybe collecting dividends on that. I hope to be collecting options premiums, and I've also got USOI. You can see that right now on my USOI position, I'm currently down $2,491. However, all is not as it seems because they paid $3.33 a share, and I'm going to get that money on Monday because that's when the pay date is. And if you multiply this number by 650 shares, I got $2,164 coming to my account on Monday. Now I'm currently down $2,491 a position, so all told I'm down $327 at the end of the day. However, what I would expect is that next month, I have no intention of selling this at all, but what I would expect is that next month, I'm hoping for a really nice dividend payout. Now they do come down from a low of $1.23 up to like a high of like $5.06. Last month it was $3.33. I'm kind of hoping for a couple bucks a share this month, and maybe I can make $1,300. And also that would make it so that I'm actually not even down on that position anymore, because every time I get money for it, like right now I'm at $84 a share is my cost basis. But once I get $3.33 a share, my new cost basis on USOI is going to be $80.67 a share. USOI is currently sitting at $80.20 a share, meaning I'm down about 47 cents a share on my position. Now, if you look at USOI over the past 5 years, remember oil went negative here in April of 2020. So it's actually been pretty steady since, say, July of 2020 through now. As a matter of fact, if you actually bought USOI right here in October of 2020, you'd actually be up on your underlying position, plus you'd be collecting all those dividends month after month. So whoever bought on that date and held it is a pretty lucky person. So let's have a look at some of my other positions that I have open right now. I've also got Chevron. Chevron is going to go X on the 15th of February. Oh, wow. It went X already, like 10 days ago. So I'm going to collect dividend there, going to pay me on March 10th. What about, say, ConocoPhillips here? When does that dividend come out? It goes X on February. Oh, it went X. Wow, I got some dividends on the way. I'll tell you, I'm selling calls on these things. I'm selling puts. I'm collecting dividends. I think I'm going to get share appreciation because I do expect that oil is actually going to do the same as the stock market. Like the market right now for me is very, very easy. I think that the market is like caught in like a trading range between, say, 4,100 on the high side and 3,700 on the low side. This is a very easy market for me to trade right now. I'm just buying very fairly valued stocks that I think have the potential to go up, that actually pay a nice dividend. And I'm just going to wait this thing out until the Fed decides that they're going to pause interest rates, in which case I might start getting in more into Google, Amazon, Microsoft, and things of the like. But for now, I'm just perfectly happy doing this. This is a very easy market, like I said. Same with oil. Like oil right now is in the same range like the market is between 70 and 90. I think that as Q2 rolls on, we're going to get closer to 90 and further away from 70. It's just kind of the way that I feel. So I think I'm getting oil stocks at a good price right now. All right, that's going to do it for this week. If you got anything in this video, please like, subscribe, hit that notification bell. Until then, we see you next time. Have a great day. Bye. And now a word from my sponsor. Guys, have you ever wanted to drink something that looked just like oil? Well, you can now with my sponsor this week, which is beer. This one smells strange. Tastes really good, but I don't know what that smell is. Actually, it tastes like liquid gold. What is in this thing? Ah. Okay, this sponsor this week is Purple Monkey Dishwasher. This is a chocolate and peanut butter flavored beer. That would explain that strange smell. Hold on a minute. Yep, that's peanut butter. That's what that was. All right, hold on a minute. I like it. It's from Evil Genius Brewing Company, and I have to give this can of beer 5 Cape Roonies out of 5. Have a great weekend, everybody.